You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here, and today I want to talk to you about a strategy you can use to basically lower your tax liability if you are later going to look to sell an asset where you've made a significant capital gain. So this is called tax loss harvesting. Now, basically, I've utilized this strategy myself this week, and I plan to take this loss forward with me into the end of the financial year to then offset a future gain if I decide to sell a position in another stock that I own. So I'm going to switch over to the Investopedia website right now and just read through some key points about tax loss harvesting with you so that you understand exactly how this works. We'll then talk about the specifics of doing this in Australia and why you may not want to purchase the same position back in the same company, because this can become conflicting with the tax loss harvesting rules becoming a wash sale instead. So what you need to do is perhaps buy a new position in a new company where there's a better investment opportunity. So I'm switching over now. So as you can see here, how to avoid violating wash sale rules when realizing tax losses. Now, tax loss selling is an investment strategy that can help an investor reduce their taxable income for a given year. Tax loss selling involves selling a security that has experienced a capital loss in order to report it as a capital loss when filing yearly income taxes, and thus lower or eliminate any capital gain that may be realized by other investments. So, in order to successfully realize the loss for tax purposes, you have to take the step of liquidating the position during the tax year. Any unrealized loss on an investment cannot be deducted from your income taxes. Sometimes an investor will decide to replace that security with a similar security, allowing them to maintain a consistent, optimal asset allocation and achieve their desired returns. If you take this approach, it is important to be mindful that you do not accidentally trigger a wash sale in your investment account. Okay, so I'm just going to sort of summarize before I have a look at these takeaways. So if you do decide to actually sell a position, you want to completely liquidate that position so that you can offload the loss in your portfolio. This will essentially lower how much your capital gains liability will be on another investment in the following financial year. So for example, if I invested $1,000 into a company and my investment went down to $300 and then I sold it, I could realize a $700 tax deduction against a capital gain in the following financial year. So if I made $2,000 on another investment the next year and I sold, what I could do is utilize the $700 loss on the previous investment. I then roll that forward into the next year, and on that $2,000 gain, I would only need to pay my nominal tax rate on a $1,300 amount. Okay, I hope that example makes sense. So the key takeaways: wash sale rules prohibit investors from selling a security at a loss, buying the same security again, and then realizing tax losses through a reduction in capital gains taxes. Now, why people may be intrigued about this sort of method is if you sell at a loss and then you buy again, you've lowered your cost basis, so your likelihood of making a gain on that same investment is a lot higher. However, like all things, this comes with its own risk, because if the ATO or the governing body in your country decides that you have done this as a wash sale, they're not going to allow you to utilize that tax loss on the previous financial year, and therefore you may actually end up just with a big tax bill regardless. So, tax loss selling is an investment strategy that can help an investor reduce their taxable income for a given tax year. Investors may be able to claim up to $3,000 in capital losses per year in order to offset their taxable income if they are married and filing jointly. Now, I'm not sure if this particular rule actually has any carryover into Australia's taxation legislation, but this is how it works in the United States. Now, a common investing strategy for avoiding violating the wash sale rule is to sell an investment and buy something with a similar exposure. So if you're doing this with index funds, that might look like if you owned VTS, you could sell VTS and then purchase IVV. So you would sell the entire stock market in the United States, that ETF, and then you purchase IVV, which was just the S&P 500. So you essentially have a very similar exposure, because the majority of the entire stock market in the United States is made up of the S&P 500, with only a small percentage outside of that making up the next 2,000 companies. So that makes sense. Now, what is a wash sale? A wash sale occurs when you sell or trade a stock or securities at a loss, and within 30 days of the sale, either before or after, you purchase the same or a substantially identical investment. The wash sale rule is a regulation established by the Internal Revenue Service, or IRS, this is in the United States, in order to prevent taxpayers from being able to claim an artificial loss in order to maximize their tax benefits. Now, I've been doing a little research here for the Australian legislation on this. Now, if the taxpayer disposes of or deals with the asset at the same time or within a short period after acquires the same or substantially same asset, this is counted as a wash sale. So you cannot actually do this. Basically, if you purchased, let's use the same example, so $5,000 of VTS and it went down by $1,000 and you sold it and immediately bought the same stock again, this would be counted as a wash sale and you wouldn't be able to claim that capital loss of $1,000. I hope that makes sense. So generally, if you're going to sell out of a position with the intention of buying it back, you need to speak to your accountant in your country and make sure that what you're doing is actually completely legal. It looks to me in Australia as though if you were going to utilize this, you need to make sure you definitely want to sell out of that position. So you have to at least wait until the next financial year to purchase that same asset in its same way again. Obviously, if you decide it's still a good investment opportunity and you buy it again and you just disregard completely that tax loss, it doesn't matter because you can still lower your cost basis. You're not going to worry about claiming that taxable loss, but you can increase your position in the company. That makes a lot of sense too, if you feel like it's still a good investment opportunity. Now, shortly prior to or at the time of disposing of or dealing with the asset, the taxpayer acquires the same or substantially the same asset. And shortly prior to, at the time of, or shortly after disposing or dealing with the asset, the taxpayer enters into an arrangement to acquire the same or substantially the same asset at a future point in time at a price that is substantially the same as the sale proceeds received on disposal of the original asset, and acquires that asset under arrangement. So that might be like if on a Thursday I sold out of my position and I bought back into my position on a Friday. There's not going to be too much of a price change in that time. What you want to do is actually wait at least 30 days if you're in the United States, and potentially a lot longer here in Australia. I'm actually looking to hear back from an accountant on this matter so that I can really clarify it. But for now, we're just going to talk about the tax loss harvesting aspect of doing this in your portfolio, because the wash sale rule may actually be very different. Now, if I come back to this wash sale, when a wash sale occurs in a non-qualified account, the transaction is flagged and the loss is added to the cost basis of the new substantially identical investment you purchased. If you continue the trade of the same investment, the loss gets carried forward with each transaction until the position has been fully liquidated for more than 30 days. So if you're doing this in an actual brokerage account over in the United States, your broker will actually automatically carry forward that original cost basis, and they're not going to claim the loss. But if you actually sell and you keep that position closed for 30 days before buying again, the new cost basis will be at the cost that you actually purchased again at, because now it is no longer a wash sale. Now, the same rules apply if the spouse of the individual that sells the security or company controlled by the individual purchases the same or substantially equivalent securities within the 30-day time frame. So if you thought you could maybe sell your $5,000 worth of VTS and then your partner could simply buy VTS back for $5,000, it unfortunately doesn't work, and they're onto this. So when you're actually lodging your tax return, you need to be very, very careful on these particular things. So I guess in summary, when you are looking to do this, what you might want to do is actually find a similar company in the same industry. That way you can actually capitalize on this. So I recently sold out of a position in a speculative stock I owned, Callium Lakes. Now, I only put a little bit amount of money in this, okay? So very small amount, and I held for 3 years. As you can see, I had an annualized return of minus 52.79%. I originally put in about $1,200, so I ended up selling for very little money back. So with my $700 loss, that's going to carry forward into my next financial year. And then if I want to offset a gain that I've made, this $702.40 loss will actually offset that. So if I sold another position and let's say I made $702.40 exactly, that would completely wipe out my tax liability on that gain, and then I would be at a net even basis when it comes to my capital gains lodgement. All right. So as you can see here, my holding lost $702.40. I received 0 dividends and 0 currency gains. So the overall loss is exactly 52.79% per annum. I held this for about 3 years, and it's got all of my order history here. So I just utilized my free brokerage, and whenever the share price dropped, I added a little more if I had spare change in my account, but I never really cared about this investment in terms of wanting to make it a big position in my portfolio. It was always speculation, as somebody close to me had told me about this company and suggested I put a little bit of money into it. Thank God I did not take it seriously and put a large sum of money in. So as you can see, as the price was dropping, originally 65 cents, 50 cents, 15 cents, 13 cents, 18 cents, and then 6.8 cents I sold it at. Now this was a little bit of a strategy. The $161.11 I have, I can put into another speculative stock, or I can just put it into an index fund when I make my next purchase. It's essentially going to benefit me long term to have sold now, but if I decide this is now a prospect I want to own, in the next financial year I'll be okay to make a new position into this. But again, I'm waiting to hear back from my accountant, because that's the responsible thing to do if I wanted to buy back in. Alright, so when it comes to utilizing the tax loss harvesting rule, there are a lot of I guess managed funds and robo investors that do this automatically on your behalf. Just understand, you don't want to be trying to utilize this without understanding exactly why it's happening, because every time you lose money, you don't get that money back. So every time you cement in one of those losses by actually selling your position, that is essentially no longer a paper loss, and it's cemented in time. So I've just lost $700, and when I look at that as in how many days it would take me to earn that, it's actually a little bit depressing. So make sure if you are going to utilize this, you understand why you're doing it, you have a new alternative investment that you want to put your funds into, and that you're not going to get caught out by the wash sale rule, completely voiding your chance of utilizing the tax loss harvesting legislation. You want to not become part of the wash sale clause, because then you pretty much wipe out that loss. You lower your cost basis if you buy back in, and then you know what? When you go to sell that position later down the track, you have a bigger capital gain to claim. So that makes things extremely expensive for you in the future and now. Alright guys, if you got any value from this video, please like, share and subscribe. One thing I do want to mention is that your capital losses made in the share market can offset capital gains in property and vice versa. So this could be also a strategy you employ if you were deciding to sell a property for a gain around the same time, or the next financial year, sorry. But yeah, apart from that, guys, I really look forward to seeing you in the next video.